And the liability extends, for instance, if they have a low policy coverage of maybe $15,000 and that the injuries perhaps exceed that, they
Right.
could go after the registered owner. There's some liability there.
Right, so you bring up a good point, which is the coverages. And you know, when you go through a divorce, most likely you haven't looked at your coverages for a few years. And the coverages really should match the assets you have. So if you know, have $1 million worth of assets, you should probably have $1 million worth of liability to protect that. So, you know, as you separate, you know, your asset mix may change and or your asset levels may change, and so it's a good time to revisit. But to answer your question about having lower limits like that, you're absolutely right. So what happens is, in my scenario where I had the accident, if I had low limits, just because if somebody sues me for $100,000 and I'm carrying the state minimum, like you're talking about $15,000, I'm now personally liable for that extra $85,000. If my wife is still registered on my car, now she just became liable for that, or ex-wife, she just became liable for that as well. So it really is a good time, especially if somebody else has been the one taking care of the insurance, or you haven't looked at the insurance in a while. It's really a good time to revisit those coverages and make sure you have the liability that you need. Another piece of that is the uninsured motorist part. So for example, if you hit me and you don't have enough insurance, or you don't have any insurance, my policy, if I have the proper protection, will still protect me as if you had that insurance. So that's important too. So as you're going through the review, you know, it's really good to go with, you know, with a broker or agent and go through all your policy coverages, make sure you understand what they mean, and pick levels that are right for you.
So if you had, you know, $1 million net worth combined with you and your spouse, and you're getting half the assets, let's say now $500,000, you're going to want to lower that potentially?
You could. It's one thing to consider, especially at your time of saving costs. Although I will tell you that the cost differential is very minimal in those kinds of situations. And the other thing is, it's not only your assets, it's what your future income is. So if you're going to, you know, you may not have a lot in assets, but you're making $100,000 a year, then in California they can come after a portion of that. They can garnish your wages. So one way or the other, it's still a good idea to just, again, kind of assess how much you have, how much you might be making, and then select a proper coverage. And like I say, going through a divorce is a perfect time to think about those kinds of situations.